The US Fed has finally cut interest rates. What is the impact of that on the Indian equity markets? To discuss this and more, I have with me Devender Singhal, Equity Fund Manager with Kotak Mahindra Asset Management Company Limited. Hi Devender, and I must start off the conversation by asking you about this US Fed rate cut. What does it mean for our own markets? Do you see that perhaps now more foreign money will be coming into India?
So, Mumina, we've all been waiting for this rate cuts to happen, and finally, as you said, it's started happening. What's encouraging is that the Fed is also looking at even larger cuts or similar size cuts going forward, depending on how the data comes in. So, this is good news for the developing market therein, because whenever the interest rate starts declining on the developed market, especially the US, which is a big funder for the world, then developing markets or emerging markets are at the beneficiary end. Now, the difficult part is you can't time the flows as to when it would start coming in, whether it would be immediate, it would be 3 months, 6 months, 9 months down the line. But if the interest rates in the US starts coming down, there's no reason why the flows from the US market would shift to the developing markets, and India is rightly placed to capture a lion's share of those flows going forward. So yes, optimistic about that. Flows should be there. And with all the economic growth happening in the country, with the fastest moving economy in the world, I don't think FIs have a choice.
Now, of course, there's another part of the story that a lot of investors complain about when it comes to India, and that is the valuations. Our valuations are quite lofty. Do you think that this potential of economic growth that India has is something that justifies these valuations?
If you talk to me for the next 5 years, 10 years perspective, definitely there's enough and more money to be made in the markets. But if you talk for the next 1 year or 2 year, I think expectations need to be mellowed down. You need to have moderate expectations. We have seen a fantastic run over the last 3 years. I mean, 25 to 30% returns across the market cap is what the markets have delivered. I think expecting something similar happening over the next 2 years, I think it's a bit foolish in my view. But moderate expectation of high single to a low double digit numbers on the back of what has happened over the last 3 years, I think we are still good. Second is, Momina, you would also understand that the earnings growth rates are very, very strong. When we're talking about the mid caps, which is the most expensive, the market cap space therein, we're still talking about 18 to 24% earnings growth. That itself, it speaks a lot. So if you talk about 2 or 3 years down the line, the valuations look still reasonable. But yes, in between corrections could be there.
Let's talk about that large cap versus mid cap bit, because mid and small cap stocks are trading at much higher valuations compared to large cap. But are you seeing investor interest increase towards large cap stocks now?
See, in the talking points, it is coming that people want to move to large caps. But if you look at the data, it is still not suggesting that the money is moving to large caps more than the mid caps. So the percentage allocation in terms of the large caps is still lower than the percentage of what the mid cap and small cap has been. So to that extent, yes, it is expected that the large cap should have a basically, a mean reversion, but it's still not happening.
All right. And to sum up our conversation, please share some words of advice to all the equity mutual fund holders that are listening to you.
The only advice I give to the equity fund holders is keep your calm, keep a long-term horizon. If you are in the market for next 5-10 years, there's huge amount of money to be made. But it would not be a smooth ride. It would be a volatile ride. You would see corrections happening. 10 to 30% corrections are very normal in the market. So be ready for that. Keep a moderate expectations. The historic returns have been around 12 to 15% for the market. Active funds have gone slightly better. So within that range, if you look at, I think even a 15% CAGR over the next 10 years, I think it's a fantastic return. And I think that's a high possibility event happening for Indians.
All right. Words of wisdom. Thank you so much, Devender, for joining us.
Thank you. Thank you so much.
Well, stay invested and most importantly, stay calm during volatile periods. That's the word of advice. Thank you so much for joining in. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.